Hey investors, welcome to the channel. Friends, in this video we're going to go through the CANSLIM method of investing and how can you apply this in India. This is not an investing advice, this is just for information and knowledge. You can take an informed decision after watching this video. This is just the intent for this channel. And with this research, we are going to see and learn about what is the CANSLIM method of investing and how can you use this. So the beautiful part about the CANSLIM method of investing is that it applies both technicals as well as fundamentals analysis in stock evaluation, which is the right thing to do. Technicals alone and fundamentals alone are not the right approach. You should always have this techno-funda approach in investing to make good returns in the short run as well as in the long run, right? So this is a beautiful part about this approach given to us by William O'Neill, and this is what is the reason for the super performance of the stocks which are shortlisted through this criteria. Now we'll go to the each letter in the acronym CANSLIM, and starting with the C first, which stands for current quarterly earning. And in CANSLIM, William O'Neill suggests us to shortlist stocks with quarterly earnings growth of 25% and above, meaning for each quarter, whenever you are evaluating the results compared to that quarter, the EPS results, which is earnings per share, should be above 25%. This is the first criteria, it's a fundamental parameter. The second is annual earnings growth. This again should be more than 25%, which is the CAGR at which the company is growing, right? So this is A, which is annual earnings growth. Now the N stands for the newness, the new factor, which is the company bringing any new product in the market which can spark the interest of investors and can create future business value or future economic value for the business in times to come, meaning it is having a good promising future if they're producing new products. And like new management also is the newness factor. Like if a new CEO has come, right, and he's willing to do some changes to take the company forward, right? The S stands for supply and demand, meaning is there a good demand for the products compared to the supply, compared to the supply of shares, meaning is there a good demand for the shares of the company, meaning are people willing to buy the stock, right? Then I stands for very important, institutional ownership, meaning are foreign institutional investors or domestic institutional investors wanting this company, meaning do they have significant stakes in the total market cap of the company, right? And this again can vary from company to company, but at least 30-40% should be owned by institutional investors, right? Institutional ownership is very important. Then L stands for the leaders, meaning the company should be a leader among its peers in the market space, right? This is again very important. So and then M stands for the market direction. You never want to take a position against the market trend. If the trend is uptrending for the stock, then only you take the position, otherwise stay out or move out of the company as per the exit criteria. And here William O'Neill gives a very good entry in the technicals when in the book which he has written. He gives a very good metric of cup and handle pattern, which is the stock, which is the price action chart you can see here. And cup and handle pattern is basically when the price is making this cup pattern, and a small handle is found where the previous high the current price is not able to break, but then suddenly a high volume comes, which is mainly institutional buying, and a breakout happens over here, right? And this is the buy point which William O'Neill says at which you should enter the market ideally with that stock, right? Then very important, in the book he talks about the safety net. Always have 7% 7 to 8% stop loss. You are not supposed to hold the company, according to Neil, if it loses 8% of the stock value, meaning if your price falls below the 8% at the highest high, you should exit without any exceptions, meaning the company has, you have to cut the losses basically, right, and capture the gains. So this is what all Will and O'Neill covered in the evaluation. But then again, you have to decide how is your position sizing going to be depending on your risk appetite. I would say if you're starting new, don't have allocate too much of your portfolio to this one strategy. Test it out with, let's say, 10% of your portfolio, right, and select at least 10 to 15 stocks which you can watch, because this would require watching. If you're not willing to watch your stocks, then go for the mutual funds or index funds, where it's like a set and forget kind of a strategy. But this is like active watching against your stocks, right? So but here again, the good strategy for standard rule is to take 20%, 20 to 25% of the profit on each stock, and then take an exit position. And that again is very personal from person to person, but good rule is 20 to 25%, right? So this is pretty much it from the CANSLIM approach. Again, just for the recap over here, C stands for current earnings per share, which should be above 25%. A stands for annual growth rate, above 25%. New is the new product. High is management, any newness factor. S is demand and supply, high demand for the supply of shares, right? Volume spiking, meaning, right? And L stands for leaders, where it is having among the peers in that same sector, the company should be a leader. I stands for institutional sponsorship, which should again be on the rising trend. So this is it from the CANSLIM approach. Now I'll show you how to apply this in the Indian context. If you go to the screener.in, and go for the screens over here, you can find many screens which have this CANSLIM formula, and you can also make your own screen, right? And based on the same formula, this is somebody else's formula, but you can make the query, you can change the query, create your own screen, right? And when you run this query, you will shortlist stocks. Now the thing is, once you shortlist stocks and dedicate a portion of your portfolio, you have to actively watch it, or set reminders for the stop loss. So as soon as the stock hits stop loss and you capture your gain, you should be able to exit, and then repark that money only when the market is uptrending and you have a new list of stocks. So this is how you rotate with this strategy. And if you're someone who's looking for more active involvement in the stock market rather than being passive, you're retired or something, then this can be a good strategy to be considered, right? Along with the Joel Greenblatt's magic formula, which I've made a video earlier on. So I hope this was helpful to you guys. Thanks again for watching the video. If you like it, do give it a thumbs up, do subscribe to the channel. Let me know in the comment section below, how do you like this presentation, how do you like the video, and I will create much more videos for you based on your request. So thanks again for watching, guys. I'll see you again in the next video. Till then, take care. Bye bye.